Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading weekend in April 21st, 2023. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is a calm before the storm. Why don't we get into it and just kind of see how things are shaping up? First, we'll take a look at the prior week, see how that moved out. You can see here as I bring it up on the screen here, pretty much a flat market. Dow, S&P, NASDAQ, all just slightly in the red, Russell slightly in the green. Year to date, everybody's solidly in the green. Dow up 2%, S&P 7.6, NASDAQ up a strong over 15%. Russell just barely hanging on at 1.71%. Very quiet week. Q1 earnings seemed to grab a lot of the spotlight. Economic calendar was fairly weak fairly weak or light, I guess, for this week. The VIX fell to its lowest level since 2021. I mean, if we look at the 3 weeks into April, the S&P's moved up just 60 basis points. And if that trend holds up, this will be the smallest monthly change since 2022, May 2022. So that's why the VIX has fallen to levels we haven't seen since early 2022 or late 2021, right? So just a fairly calm week, but I could believe it could possibly be the calm before the storm. If you look at the PE ratio, it's at 18.6. Forward is 18.92, relatively flat from the trailing 12-month and the forward 12-month. I do believe 18.92 is a little bit too high. It's probably going to come down a little bit. You can see the Treasury yield is at 3.5%. Dividend yield for the S&P is 1.67. The earnings yield is 5.33%. So it is now over the inflation rate, not the core, but the headline number. The real yield is about 0.33%. So still fairly low. The VIX, as I said, it fell about 2.87% for the week, coming in at 16.58. You can see the best performer for the week was Staples, which is a risk-off sector. The worst is communication services, although it's the best year to date at 12.88%. Financials or year to date still the worst at a little over 10%. So officially in correction territory for the financials. We did see this week weekly jobless claims brought in signs of just the weakness, just slowly starting to creep back into the labor market, which is what the Feds want. It might encourage the Feds to dial back the rate hikes. However, we did get the S&P Global Composite PMI data. That's when it combines both services and manufacturing. It came in at 53.5. That's the highest level we've seen in almost a year. Okay. The S&P Global Manufacturing also defied expectations and came back into expansion territory at 50.4. So that is going to tug on the Fed ropes to probably continue their quest to tighten the rates. In fact, there's currently an 87% probability the Feds are going to hike the rates May 3rd, bringing the rate to 5.25%. So we're seeing a lot of strong activity here in the markets, but it's very weak as far as trading activity goes. Volume's low, really not going anywhere. I suspect over this next week or 2 weeks, we're going to get a number of activities that are going to move up, especially the Feds. If we go over to the European markets, you can see Eurozone business activity picked up in April. The PMI data there, the composite comparing services and manufacturings are combining them, came in at 54.4 from 53.7 in March. So it's also increasing just a little bit. And we're seeing minutes from the March meeting of the ECB. They're kind of determining whether they're going to do 25 or 50 basis point rate hike. They're on record as saying 50, but we'll see how that plans itself out. Meanwhile, the annual UK consumer price index grew less than expected, or it fell less than expected from 10.4 in February to 10.1 in March. So it's still very, very high, primarily because of food prices. Also in the UK, their composite PMI rose for a third month to 53.9. Okay, so all in all, the markets are holding up fairly fine. You can see everybody's in the green over in Europe. The Euro stocks, FTSE, CAC 40, and DAX all up, but around flatline. And you can see year to date, 3 of them are in double digits. The Euro stocks, CAC 40, and DAX all in double digits. FTSE, which is the London index, only up 6.21%. And then, of course, if we go over the Asian markets and look at Japan, their CPI rose 3.1% year over year, pretty much in line with expectations. It did hit a 41-year high in January, but I'm seeing here with this new Bank of Japan, um, uh, uh, the guy that's going to be running the Bank of Japan, rather, there's signs that he's probably going to lead their bank to consider tweaking its policy of yield curve control, which could goose the yen, which I think is going to be a great trade opportunity as this year moves forward. Also, the Chinese equities, you can see they're in the red, both of them. Their equities fell a little bit. They had some mixed data. Also, worse sentiment with the U.S. introducing fresh investment curbs in China. That's kind of continuing to weigh on the Chinese markets. Although their GDP did come in better than expected at 4.5% in Q1 from a year earlier. But remember, they're just coming out of their zero COVID policy in December, so we should expect positive growth results because you're comparing it to pretty much a flat line last year when everything was shut down. Um, we are seeing that they're continuing to invest in infrastructure and investment there. The Chinese government, like Japan, is still stimulating too, but I suspect that will end shortly. If I take you over and just show you the charts real quick, let me just swing this. Where are we here? Let me just move the screen over here a little bit. I'm going to take you over to the E-mini S&P 500 futures, and you're going to see here. It's going to take about 10 to 15 seconds to come up on your screen. But what you're going to see here is it could be a double top or it could be going higher. But look at the price action here. All of these are dojis. Most of these are dojis, these candles, which indicates a little bit of confusion as to where the markets want to go. And if I click on the volume bar, you can see how this purple bar is the 5-day moving average of volume. The blue bar is a 20-day moving average of volume. So essentially 1 week against a month. And you can see it's well below as we've been moving up. So just this big move up off the lows here made early March um, basically are done on much lower volumes. So, and you can see this is a key fib note here at 0.236%. So all of these things are really holding the markets and compressing them down a little bit. Okay. And you can see here on the MACD what we would call a poor man's bed, which would suggest a little bit of a dip. Now, as I said last weekend, I said we can expect a dip down into this range down here around 40.50 area. I don't see it going much lower than 40.50 before consolidation starts moving back up again. So I think that would be what I would expect to see happen here. Of course, and then if we move down here and we take a look at VIX, you can see the VIX very quiet, very calm for the VIX. As you can see here, we hit a low here of 16, 17. We haven't been that low in quite some time. Going back to Q4 of 2021, actually. But once we get down at this level here, as I'm telling our members, this is when you want to be picking up hedges and putting things into the market, because I suspect this is going to change fairly soon. We'll probably see the VIX come back up into the mid 20s over the next 3 weeks, going into the end of May. And then I think it's going to settle back down and come back down again. That's kind of what the markets are showing me right now as far as the charts go. And if we look at the bond market, you can see as bonds go down, always interest rates go higher. Hang on 1 second, guys. Let me just, I got to mute my mic for just 1 second here. Hang on a minute. Okay, so as you can see, we're pulling back here on the bond market. I do believe we may have a little bit of a rally here with interest rates coming down. But as we start to get the Fed through May 3rd and they hike the rates up, I think there's a greater probability of rates going up near term and then rolling back over again. Because remember, the bond market is suggesting we're going to have 1, maybe 2 rate cuts at the end of this year. That's what's kind of giving some buoyancy to the equity markets right now. And of course, if we come down here And look at the dollar. The U.S. dollar is near the lows for the year. I mean, it's just I suspect any rally in the dollar is going to be sold. And our long for the year is euro. All right, we want to be long the euro, and my target for the euro is up around $1.11 to the dollar. But I suspect it's going to pull back a little bit, but it's going to stay. It's going to consolidate. So we do like the euro to the upside, the dollar to the downside. I also like the yen to the upside too. Now, maybe not near term, but I think the Japanese Bank of Japan, as I said, with this new Bank of Japan governor running things, inflation's coming in hot. I think they're going to be forced to change their yield curve control, which is going to strengthen the yen against the dollar. So you got the euro being strengthened against the dollar index, so with the yen. So that's all going to serve to push the dollar down, right? And remember, there's three currencies, euro, yen, and pound, that account for about 80% of the dollar index move. And the euro is almost 58%, so that's a big part of it. Um, and then, of course, if we come down here and we take a look at gold, I had told our members to start shorting gold up at this level up here. Longer term, I'm long gold, but I think it's going to pull back a little bit, consolidate, and then make another run up. Okay. So some of our members jump on this. I think some still in it. Some got out fairly early, but it's a good trade. I think you can do well in that one to the downside, near term. Long term, again, long gold. And of course, if we look at silver, silver has a higher beta than gold. It tends to move lower. Didn't pull back quite like gold did, but it's had a great run off these lows down here. It played catch up to gold essentially, but it's in the same position. It's going to pull back a little bit, consolidate, and then move higher. Is what I'm looking at for silver. Of course, oil. All the analysts are saying oil is going to move up. You can see here where oil is back in the red again for the year, but it's going to consolidate around this level. It's going to probably fill that gap at 75, 72, and then just take back off to the upside again. So we got ways to trade oil that are very lucrative for us. So that's kind of what we're doing right now in the oil market. All right, guys, that was a very quick rundown on the markets this weekend. Members, I will see you Sunday evening. We'll spend a lot more time going through some more details and some potential plays out here. Otherwise, make it a great weekend. Members, I'll see you Sunday evening. Take care, folks. Ciao now.